Hello and welcome. In this video, we are going to talk about something very important, that is, how to stay safe, smart, and legal in the Indian stock market. Alright? Now, when you first enter the stock market, everything looks exciting, right? Stocks going up and down, people saying buy this is a multi bagger, and social media full of stock tips. But this is exactly where the beginners go wrong. Alright, so let us look at some mistakes that beginners do. First is following the crowd. Most people buy a stock just because someone else bought it. It is like standing in a line without knowing what is being sold at the counter. Okay? Don't just follow the herd. Always do your own research. The person who had bought the shares and maybe who had recommended it to you might have done his own research, or he might not have done it at all. So, if you follow what he is doing, then the chances of failure is more. Understand what the company does, how it earns money, and whether it actually has potential before putting your money into the market. Okay. Next, no plan, only emotion. Most beginners buy a stock and then hope that it goes up. Now, this is not investing, this is gambling. Before buying, one must decide the entry price, target price, stop loss, and the duration for which the stock will be held. It is like planning a road trip. You cannot just start driving without knowing where you are going. Correct? So plan everything before buying stocks. Mistake number 3 is putting all eggs in one basket. Some people invest all their money in one stock. Why? Because a friend said that it will double. But what if that stock crashes? If that stock crashes, then all the money will be gone, right? So always diversify. Keep your money spread across different companies and different sectors. Think of it like not depending on one friend for everything in life. You need balance, right? Next, emotional investing. When markets rise, beginners get greedy. When markets fall, they panic and sell everything. This is not how investing is done. The stock market rewards patience and not panic. So don't react emotionally to every price movement. Stay calm and stick to your plan. Every listed company shares its quarterly results, major decisions, and important announcements publicly. Keep track of all those things and invest wisely. Okay? Next, following fake stock tips. You might see groups or messages saying, buy this stock today, it will double in 1 week. Or buy something and this will give you 10x returns. Or you can also find account management, meaning portfolio management services. Well, all these are fake. Okay? Most of the time, these are fake or manipulative schemes. So if you follow these, then you will lose your money from stocks and from also the advisories. Alright? SEBI regularly warns against these. So be careful about the fake stock tips. Okay? Next, about taxation. I know taxes are not the most exciting topic, but if you do not know how it works, your profits might surprise you, and that too not in a good way. Okay? In India, how much tax you pay depends on how long you hold your stocks. Alright? I will explain the taxation according to the current date, meaning as of today, what are the rules? That is what I will explain in this video. Now this may change, okay, this may change. Next year, the rules may change, or by the time you are watching this video, it might have changed. So make sure to go through the new rules before filing the returns. Okay? First, we have short term capital gains, and that is 15%. Okay? If you buy a share and sell it within 1 year, then any profit you make is called short term capital gain. This is taxed at a flat 15%. Okay? For example, let us say that you buy TCS shares in January and sell them in July with a profit of 20,000 rupees. Okay? If the profit is 20,000 rupees, then you will have to pay a tax on this profit, and that is 15%. So 15% of 20,000 rupees is 3,000 rupees. So the tax is 3,000 rupees. Okay? So this is if you buy a share and sell it within 1 year. Next is long-term capital gains. If you hold your shares for more than 1 year, then your profit is called long-term capital gain. Here, the tax rate is 10%, but only on profits above 1 lakh rupees per financial year. So, if you make 80,000 rupees profit in a year, you don't have to pay any tax. But if you, for example, make 1,50,000 rupees profit in a year, then you will have to pay 10% of 50,000 rupees. Why 50,000 rupees? Because it is 50,000 rupees over 1 lakh rupees. So till 1 lakh rupees you don't have to pay anything. For the extra 50,000 rupees you will have to pay 10% tax. So that would be 5,000 rupees. Okay? Next, we have dividend income. When a company gives you a dividend, that is like a profit share. That money is taxable as per your income slab. So if you are in the 20% tax bracket, your dividend will be taxed at 20 percentage. All right? Yes. So this is the current taxation system. All right? Yes. So we have come to the end of this series, and I hope that you have understood all the topics that I have taught in this series. Apart from the topics that we have learnt in this series, there are many things that you need to learn. But all these things should be learnt as you proceed through your journey of stock market. All right? Yes.